Hey, Think Realty, thanks so much for joining us on the podcast today. My name is Eddie Wilson, the founder of Think Realty. Founded it in 2013, and as a third-generation real estate investor, I just wanted to bring information and content to the marketplace, and so that's why we brought Think Realty to life. That's what we still do today at Think Realty. We're actually live on location at our Phoenix conference today, shooting podcast, and so I've got a great guest. We'll get into that in just a second. Before I jump into that, let me say a quick thank you to our podcast sponsor. This episode is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. All right, our guest today is Riley Bishop. Riley, thanks for joining us on the show today.
Thank you for having me.
Yeah. So Riley's with Easy Street Capital. And if you don't mind, just give a quick overview of Easy Street and then we'll get into your background.
Yeah, so Easy Street is a hard money and DSCR based lender. We're asset based. We're a little bit different from your standard qualified mortgage lenders. We're not Freddie Fannie backed. We use our own private money. We're one of the more creative lenders out in the marketplace, and we'd love to look at any deals you guys can bring us.
Sure. Yeah. So Riley, you in working at Easy Street, you're working with a lot of real estate investors. Is that your background, or is your background in traditional mortgage, or how did you get into the space?
So I got into the space. They reached out to me, but I do have a background in residential real estate sales and investing. Mm-hmm. Was a residential agent for 7 years. I have a small portfolio myself of both short-term and long-term rentals. We do a couple fix and flips a year with a partner, and yeah, just kind of love the Scottsdale real estate market.
Yeah. For Easy Street, you said that you guys lend in 48 states, something like that?
Correct, everywhere but North Dakota and South Dakota.
Yeah, which is where a lot of the lenders just don't play ball because there's not, the juice isn't worth the squeeze.
It's hard to touch.
Yeah. Very good. So with all your background in real estate, what are the things, what are the trends that you're seeing today? What are successful real estate investors doing?
I'd say the guys that we're seeing with a lot of success are, they're going after turnkey stuff in markets, secondary, tertiary markets that are kind of continuing to expand. Mm-hmm. They're looking ahead of the market. A lot of the margin has been squeezed out of the most popular areas. We're seeing that, especially here in Scottsdale. I can't speak intimately for the rest of the real estate markets around the country, but I know that what we're seeing in Scottsdale with a lot of short-term rentals turning into long-term rentals or even hitting the market, I know that's happening across the country. So the guys that are doing well, they're conservative on their cash flows. They overestimate their expenses. They plan for the worst and prepare for the best.
Sure. Very good. When it comes to talking capital today, is capital getting easier to find or is it getting harder to find?
In a broad sense, I'd say it's getting easier to find because you've had lenders like ourselves enter the space over the past half decade. Whereas if you're looking for private money of this sort, you had to go to your regional bank or just guy you met on the street.
Sure.
And on the other sense, we are seeing increased limitations in what we can do market-wide. The leverage we're extending in some instances. We're seeing some instances in California and Florida where we're looking at older condo complexes we have to be a little more careful with. We can still underwrite them, still lend on them, but we do look at a few more things.
Mm-hmm. Yeah. So certain areas it's getting a little bit tighter based on just risk factors.
Yeah, absolutely.
Yeah. When it comes to DSCR, which we've talked a lot about on this podcast, just the ability to find capital that's usually just slightly over market rate right now, but to know that you're not limited to 10 deals or the kind of the conventional mindset that a lot of real estate investors have. Are you seeing a massive movement into DSCR, and is that a large portion of what you guys write?
Yeah, I'd say about half of our business is DSCR. Mm-hmm. The other half is hard money, fix and flip loans, ground up construction, bridge financing. We're doing about $500 million a year in DSCR. And we get pretty creative with it. We can underwrite on projections for short-term rentals. We can look at
that's really important because a lot of the properties that these people are buying typically for short-term rentals maybe have not been used as a short-term rental, and so I don't think people understand how important what you just said is, because when they hear a lender say, "Hey, I'll do a short-term rental loan," I'll write it as a DSCR loan, but as a short-term rental, that if it has no history, then most lenders can't lend on it because they don't have a baseline of saying what is the actual market, what is it going to yield.
That's exactly correct. And even if they can lend on it, oftentimes they'll be limited to what a regular rent schedule would look like.
Sure.
And if you're in the short-term rental game, you know that those pale in comparison to what your short-term rental cash flows look like.
Right.
I know a lot of the market has been previously reliant on STR 1007s. I also know that a lot of the market has lost the ability to rely on those 1007s. We don't use them. We use projections from an AirDNA site. If you're a professional investor, which we qualify as having one short-term rental in your market for at least a year, or 3 across the country for at least a year, we give you max on that. We look at 100% of the projections. If you don't have that qualification, if this is your first one, quite frankly, we might not be the best option for you. You're probably better off going conventional. But if you are insisting on going DSCR, we take a 25% haircut off the projection, which we find is across a pretty wide sample set, is about 95% accurate as far as what the cash flows are to be expected.
Is the DSCR rate a 1.1, or what are you typically lending on?
We can go what we call no ratio. We tier it out as far as leverage and pricing that we offer. Not to get too granular on it, but we can underwrite. We can underwrite if you're technically losing money on paper. Our best rates show up at around 1.25 DSCR.
Got it. That's great. Yeah, and if you're not familiar with DSCR, debt service coverage ratio, essentially what that means is if your mortgage is, let's say, $1,000 and you're 1.25, like you just said, then you have to be able to yield $1,250 in rent. It's essentially a percentage above whatever the debt service coverage is. And so a lot of real estate investors today, if you're not using DSCR loans, really should consider it, because if you're stuck in that kind of conventional rat race, you can only get 10, and a lot of mom and pop real estate investors, they're so used to, they get their 10 and then they put their 10 in their wife's name, and it's like they're always playing this game of trying to manage that. And it's like, as much as in the lending world, DSCR is so well known in the real estate space, especially the mom and pop real estate investor that has 4 or 5, 6 rental units, they're just so used to going down to their bank and getting loans, and that's getting harder and harder today.
And even if they don't hit their cap count, you're also limited on the other side by DTI.
Right.
So if your personal incomes can't float the note, I mean, you're left going elsewhere. To companies like us.
For sure. So for Easy Street, you said you've got a big. I live in Florida. I know that you guys lend a lot in Florida. Is that a high concentration for you guys, the southeastern part of the country? Yeah,
that's where our predominant focus is. I'd say there, the Rust Belt. We're breaking into the West Coast. We just opened up a fantastic broker program in California. So we're expanding towards the West, but the Southeast, the Rust Belt, that's our bread and butter.
Sure. I know a lot of our, something I've been teaching quite a bit is that there's the ability to broker loans as well. Do you guys have a broker program?
Absolutely. We've got our signature broker program. It comes with 100% white label funding, so your clients never know who's on the back end of the loan. You actually get better pricing than we offer retail, so it's fantastic. And if there's any brokers that want to learn more, please. We'd love to get in touch. And I think we've got almost 1,000 brokers signed up thus
That's
far.
great.
So,
that's awesome.
Pretty robust program.
Very cool. So what do you see on the horizon when it comes to real estate investing? Are you seeing any trends kind of hit today? Like what are you seeing as an organization, or what is your organization preparing for?
I think as far as like trends, ADUs, everybody's talking about them because everybody's doing them. I think probably 20% of the deals I've touched in the last month have had some sort of ADU, either looking to add, have already added, and looking for a cash out refinance. So I'd say ADUs and maximizing the existing envelope of a property as best possible. Fortunately, zoning in many of the municipalities are starting to be more friendly in that regard. Other trends, I'd say everyone's watching rates. I know there's quite a few people out there that are really looking for any type of edge in the rate market to make a move. We think we're almost there. We think the Fed's on board with a couple cuts this year, which would be nice. I guess trends as far as that goes.
Do you think that if the Fed cuts rates, we kind of historically know what that means is we move back into a buying frenzy because now it's cheaper capital. But then it's just going to drive housing value, right? Like it's going to drive the prices up. Do you think there's this window that the real estate investor has to be very prepared to get involved in if they're going to take advantage of the cheaper capital, and then ultimately that rising tide, which will be the values will just increase because the rates decreased?
Yeah, I'm prepared for it, but also cautious
Yeah.
in the event that it doesn't happen, because
Yeah.
it looks like, and I'm no economist, I won't pretend to
Yeah.
be, but it looks like right now things are kind of at an equilibrium.
Sure.
I think the Fed's happy with that.
Yeah.
So yeah, I mean, get ready to go, but ready to not go.
Yeah,
if you will.
yeah. That's where I kind of think, and I have been in the space of something has to break. I mean, there's not enough housing. There's not enough housing. Period. Where, NAR just came out a week or two ago and said there were 3 million homes underbuilt in the nation. We're seeing less than a million building permits nationwide annually, and so it's like you've got this massive deficit of properties. But we still have interest rates in the sixes, so it's like, and is even 0.25% of a drop even going to make a difference? It seems like that equilibrium, that middle space, is where everybody feels comfortable right now, where you're not seeing massive rise, massive fall. But at some point, it feels like because there's such a demand for housing and just not enough inventory, like something has to change.
Yeah, I mean, I wish I had the answer for
Yeah.
it. I think kind of an interesting event to point out was when they were first looking at cutting rates, I think, end of last year. There was kind of a fury of investors starting to get more ready to go.
Yeah.
And then the market front ran the rate cut, and
Sure.
it was kind of a nothing burger, if you will.
Yeah.
And everyone was kind of left sitting on their hands.
Yeah. It's kind of a moot point. And I mean, obviously it was tied to the election time period, which the election time period had everyone kind of holding their breath. But it just seemed like nothing moved, like it was just if you look back statistically, or just like, if you look at the numbers specific to that time period, you really would not be able to tell that anything significant happened during that time period.
Yeah.
Which is interesting. Yeah. Yeah, for sure. Well, very good. Anything that people that are listening should know about Easy Street, should know about you? Anything that you'd like to add to it?
Just a little about the company. It's
Yep.
We're one of the top DSCR and RTL or hard money lenders in the space. I think we're like 4th or 5th in
Yep.
the ranking right now. We'd love to earn any business that comes our way, and thankful for this opportunity as well.
Sure. How can they get a hold of you, or at least put their deals in front of you guys?
EasyStreetCapital.com, or I think we'll include my contact information at the wrap-up of
Yep,
this.
we'll do it. Very good. Well, thank you so much for being on the show today. I really appreciate it.
Thank you.
Yep. As a quick thank you to our podcast sponsor, let me just bring them back up again. Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit them at realpropertymgt.com. That's realpropertymgt.com. And then make sure that you have August 13th on your calendar. August 13th is the 2025 Think Realty Virtual Summit. It's our most highly attended conference that we do because it's all virtual. And so we've got a virtual summit coming up on the 13th in August. You're going to want to get your tickets for that. You can go to thinkrealty.com/virtual to get your tickets. We'll have dozens and dozens of speakers talking about single family, multifamily, all the alternative asset classes like self-storage and mobile home parks and all that good stuff. It's essentially my staff doesn't like when I say this, but it's essentially the boat show of real estate. You get to go see all the different types of real estate investing, and you get to be a part of all of that. So make sure you sign up and make sure you come be a part of that, and you'll get to hear a lot of information on maybe asset classes that you haven't heard before, as well as great insights on the economy, where we're headed, where we're going. That'll be past the midpoint of this year. A lot of things will take place, but we'll make sure to have people that can speak specific to the economy and where we're headed. So get your tickets, thinkrealty.com/virtual, and we'll see you there.